March 2020 marked the start of the COVID-19 bear market and was a month like no other in so many respects. An update on this unique economic market and social shock, and what to look out for next. As we said in our update a month ago, March was going to be a month for central bank and government actions around the world to try to combat the economic impact of the virus. And as far as Australia was concerned, the fact that we had relatively low government debt going into the crisis meant that we could afford fiscal support. The extent of the social distancing measures to achieve the necessary flattening of the infection curve was obviously well beyond initial estimates, so the fiscal support kept growing. But again, the good news is that we could better afford the 10% of GDP that the government has committed to so far, with another 6.5% in the form of lending facilities to help impacted businesses. For the first time on record, we had 2 Reserve Bank rate cuts in March, so the official cash rate is down to its effective floor at 0.25%. And also for the first time, the RBA kicked off quantitative easing, so the 3-year bond yield will also be anchored at 0.25% thanks to QE. These extraordinary measures, along with state and federal government actions, aim to allow businesses to hibernate while social distancing measures address the health risks. Naturally, for the economy, the limitations on travel, activity and anything other than essential services will see GDP contract by its largest percentage on record this quarter. The impact on employment will also be extreme. Recessions and crises always see unemployment rise, and this rise might exceed the post-World War II high of 11.2% in the last recession. February's 5.1% unemployment rate will be a well-defined baseline from which to measure the COVID-19 impact. A rise in unemployed numbers from 700,000 at the start of March by 1 million workers would see unemployment jump to 12.5%. However, the JobKeeper wage subsidy aims to support businesses in retaining staff and should also minimise some of those lost jobs. The big question, of course, is how long this will all last for, and the answer to that lies with health experts and scientists, not economists. Stock markets have naturally run for cover. It's hard to reconcile that record highs for stock indices were set on February the 20th. But since then, the peak-to-trough fall for our ASX 200 has been 39%, before a bounce as the fiscal packages took form. The GFC saw a fall of 55% overall, but that took 18 months. This bear market has been much more rapid. However, unlike the GFC and other crises, the difference this time may be that a health-related crisis should have a better defined end date, either via a vaccine or sufficient containment and flattening of the curve. The timing of this is the great unknown, but at least we should know when we are there. Other factors to look out for now include the level of the Aussie dollar, which is still close to 60 cents, helping to boost export values, the pace of the recovery in the Chinese economy, being our largest trading partner, and further stimulus measures, which can be calibrated by the government dependent on the duration and the extent of the economic downturn. The relief offered to impacted businesses via 6-month deferrals of loan repayments adds to our range of COVID-19 assistance, complementing government measures. And lastly, the housing market was still strong in March, up 0.7% on average in capital cities, but steadier in regional Australia. There won't be public auctions for some time now, which together with economic uncertainty may see a brief dip for buyers to consider. And quantitative easing has made term loans cheaper too. Stay safe, and we'll see you soon for the next market update from Bendigo Bank.